Tuomas. Welcome back to
Thank you.
F.A.C.E. And you did say that you were preparing a report that you wanted to share with us. So we're all girded up and ready to take anything you could throw at us.
Good, excellent.
All right. We
yeah,
have no fear. We have no fear.
Okay.
Until
Good,
we
good.
until well, but I'll be crying.
Yeah.
I'll be crying, mommy, when your
Yeah.
narrative
Okay,
becomes.
So we've been doing two things, and we have been doing two things for the whole beginning of the year, basically. So first is we have been building a global liquidity database. It's rather interesting, the information we get from there, but it's not ready, so I will not present it here. It will be saved for the next time. But that I will tell you that there is most likely there's a massive withdrawing of global market liquidity going on right now. And it's our forecast that the markets will keep falling from here, or there's a bear market from here till maybe late April, at least.
Okay.
So it begins,
right.
it may have already begun in the end of February. There's really interesting stuff in the, when you start to look at the global liquidity and the sources. China is dominating it completely now. So it's really something else. But the other thing we did,
so China dominating in what way? They were the only central bank to be easing. So are you saying
they do these kind of a even seasonal? I have actually explained it in my newsletter in the first findings we got, but they do these really strange seasonal injections and drainings of market liquidity, like the September October route which we saw. It was actually, it coincides with the draining of the Chinese liquidity and also the QTs of Fed and the ECB. And the global liquidity actually declined from September till October by over 500 billion US dollars. That's a massive, that's a record. So it was no wonder that, everything started to fall apart. But then actually the global USD global liquidity started to grow from around mid-October onwards. And one big factor there was China. But it's the global liquidity picture it's a very murky one, but it's basically what drives things now. So when people are talking about interest rates and earnings, that's good. But the liquidity situation is so volatile now that it drives the market. That's for certain.
I talked to Harold Malgrim, who is he's pretty well connected and through all these administrations. Do you know him?
Yeah, I know.
He's worried about the shadow banking system here in the U.S.
Of course, everyone is, but I'm not actually worried just the shadow banking system in the U.S., but the banking system in general.
Okay.
So there's like the second thing we did is that we looked at the U.S. economy. So there will be this is published on Tuesday. This is a special issue on the U.S. economy. We published this Depercon outlook each month, and we concentrated on the U.S. economy here. And we have these forecasts. I close that. Okay, so we have this forecast, and what it looks like that strangely, if you look at what happened past year, Eurozone grew the fastest, which was, I think, nobody's guess in early 2020, but it happened.
Because of the weather? Did the weather provide the buffer for that growth?
Yeah, it's basically here. The weather is here. If it would have been worse, like winter was very mild, this figure would have been negative.
Okay. So it's weather. Mother Nature bailed out Europe another season.
Basically, and actually China's stimulus. But just so the nowcast now look that the Eurozone will fall into recession, but the US will keep on growing for a while. But there is massive uncertainties. But the thing is that what we've been following for the past 5 years is China's stimulus. So it's basically, let me enlarge this. So,
did you before you really get into China, someone sent me a picture of the Chinese demolishing their ghost cities. Is that real too?
That has been going on for years now.
demolishing them.
Yeah, no, of course there's no official confirmation, but some cities they just vanish because they,
Okay.
there's no one going to live them, so they demolish them and build new. It's a
So
crazy.
that stimulates the economy.
Yeah, of course,
All
stimulus
right.
killing, but it's a crazy Ponzi scheme.
Yeah.
Yeah.
Okay.
So,
All right.
okay, but here's the thing. This is what we have been trying to educate the general populace or the analyst and investor for, I don't know, 5 years. So this is Chinese cumulative aggregate financing to the real economy. And this is what drives everything in the global business cycle now. People think it's a US, but no, it's a China and the stimulus. And this one here is past year. And it kind of, this is flow, so that's what grows. It's flow from each month. So
Okay.
it reaches a peak in September, and then it starts to decline. And what this means, what we found already 5 years ago, that this lags the European economy about 3 to 5 months, and the global economy around 4 to 5 months. So whenever this starts to go down like this, or that it doesn't grow in a trend-wise manner, the global economy will get hurt. So the thing is that now this happened in October was relatively okay still, but then it went. November and December were really bad. So we're going to see the global economic indicators head down this month and next month, and then maybe there will be a recovery in April. This is how it's going to go. I'm just telling you.
Okay.
But this has worked for several years now as we've been looking at this, but this is something people don't really.
So are you shorting, I don't know if you do it, are you shorting US equities or European equities? Huh?
We have been out of the market for 3 years, but when we got the global liquidity database in order under the forecast, then we'll go back in. But we would be, I think we would be shorting now. I think we would have gone into shorts maybe mid-February.
Yeah. Okay. Yeah, so, because we're right on the verge of very significant support here at 3,900. Yeah. If we take that out, who knows where the bottom is.
Yeah. I think we don't do technical analysis, but what I heard, what I read, it's saying basically the same things. Okay, but the U.S. economy first, the retail sales and recessions. This has been kind of a standard series. Everybody has been accustomed to these, but there is if you look at this is the collapse to the Russia-Ukrainian war, and ever since then, the retail sales have been in a kind of doldrums, but not in a recessionary territory. And the reason that has not happened while the interest rates go higher is because there has been rather massive accumulation of excessive savings during the Corona lockdown. So from the lockdowns itself, when people just couldn't spend, and then the stimulus checks. And we currently estimate that there's around maybe $1,000 per household left. And when they are gone, the US economy will simply stumble. And the reason, I said, so the yield curve shortly, is basically this. So this is the net percentage of banks tightening lending standards in the US. And as you can notice, there is the two figures here. One is for the credit card loans, which is this one. And this is the loans for commercial industrial loans to small firms. And if you look at this, you notice that we're already in both of these at the level we were in the first half of 2008, when the US economy was already in a recession. But we have to remember here that we start this tightening in an extremely low level and with high excess savings. But the thing is that when the excess savings are gone, interest rates are going to be so high that the US economy could simply just stop. Consumers could stop, just spending. And what I heard from the previous speaker, he was speaking how prices are rising everywhere, and this is what we hear also. So people think that inflation is going down, but it's actually not. If you look at the core inflation, it actually accelerated in January, and the super core, which takes out housing too, it was the hottest figure in over a year. So inflation is not going anywhere. And interest rates are going to keep rising. And when the excess savings end, I think the US economy is going to hit the wall, and it can happen probably during the summer.
Well, then why would the market just go down until April, late April, you're thinking?
The market, because of the global liquidity, but then it can continue its march forward, because the liquidity now is in the global economy is, we are not 100% sure of this, but the preliminary forecast tells us it's declining rapidly now. And when the global liquidity, the money in the global economy goes down, so does market liquidity and thus the markets. So the thing is, that is good.
Why will it stop? Why will it stop in April?
Usually it recovers in May of something, for some reason, what China does. But the thing here is now, like you good that you mentioned it, if we head into a actual downturn globally and in the US, there may be no recovery, even though the liquidity will probably stop the fall of the markets. But we are not. We are just constructing this. But I think many of you know the yield curves now, and they are heavily manipulated. But it should be also noted that they are very negative, very, very much inverted now. And if you look at the timing and how it relates to history, it sets the time of the onset of the US recession to July this year to January next year. So that's kind of the ballpark figure. But we are expecting it will come during the summer, early for the latest. And there's, of course, all kind of uncertainties abound.
And it's only going to be a 6-month recession into the end of the year?
No, it's going to be a long one, because there's also another figure shortly, but it's just because households are so heavily in debt that not as heavily as they were in 2006, but the corporations are even more indebted. Yeah. Governments are indebted. The central banks are a mess, like you meant. No one knows what will happen to the ECB. Basically, I think Eurozone governments needs to recapitalize it, and that's going to create all kinds of political issues. And what about the Fed? It's also raking up a massive loss heading into the Treasury. And the thing is that it will become a political issue at some point if the Fed, there is a recession and the Fed plans to restart the quantitative easing. I'm thinking that Republicans at least will say something about that. That are you now gonna increase the future losses? So central banks have been acting since 2009 in a way they're what was never supposed to act. So they're doing stuff they shouldn't. And that's.
Let me ask you this, Tuomas. That I brought this up, that in bull markets, anything that could go wrong doesn't. In bear markets, anything that could go wrong does. And the debt ceiling issue is going to become real critical in June, where we Treasury runs out of unusual means to keep things going. And 100% of the people are saying, well, it'll be a lot of political theater, but just like always, they'll raise the debt ceiling. Could the U.S. be setting itself up in this environment for a self-inflicted wound? And it could be used as an excuse for everything else politically?
Well, it could. But I think more has to happen before that really occurs. But it's just.
You think they're going to raise the debt ceiling then?
Yeah.
Okay. See, we're still at 100%.
Yeah, we are.
I'm the only one. I'm the only one. And it might be a mistake because maybe someone couldn't get to Congress, they got snowed in or something. Yeah. Anyway, so all right. So, because a lot of people are talking credit events starting in June, July, and
I think they are going to start earlier.
Okay,
but we'll see.
Where do you think they'll start? Where do you think? April. Okay, and what do you think? Give me a guess on where you think the source is going to be. Is it going to be something like BlackRock, where they wouldn't redeem?
I don't know. Honestly, I haven't analyzed that, so I will pass of saying.
Okay.
But we just think about the timing. But coming back to the US economy, there's two other things I want to talk about. The first, of course, is the consumer sentiment, and it's in the very recessionary levels still, which is where it fell over a year ago. And this tells something also, and I think it's very difficult if you think about the increasing of the tightening lending standards, the interest rate, all that. It's very difficult for the consumer sentiment to rise here much. It probably will rise a little, but I think this is a done deal. The recession is baked in. It's already there. The US cannot avoid it. I cannot understand why people are talking that there will be no landing. Because every single thing, if you look under the hood of the US economy, tells us the recession is just postponed, but it's coming. And that's like, yeah. So I think that's strange. But there's more, actually. Oops, where did I go now?
All right.
I'm going to stop sharing for a second, then I'm going to take another. Yeah.
Okay, I wanted to ask you who's selling gold?
I don't know.
But
usually, the thing is that usually gold, when we look at the historical crisis or periods of recession or whatever, or bigger problems, gold usually entering into the crisis, the gold usually sells, and then the buying starts about a year after. But there's one more thing, and this is crucial. This is just past week we talked with this on a banking expert who has done, handled banking crisis in the IMF and back in the days and all that. And we were wondering what is going on here. So there is two series now. So there's the first one, the red one is a regulatory tier 1 capital as a person share of risk-weighted assets, while the blue one is the regulatory tier 1 capital as a percent of assets. So if you look at the blue one first, there is this quite a big drop here, which is most likely related to the massive quantitative easing the Fed launched in during the COVID. Yeah, it pushed a lot of assets into the balance sheet of banks, while the tier 1 capital didn't raise. So okay, that's a good explanation. But the red line here is really strange. This massive jump here implies, from here we know that the regulatory 1 tier capital didn't increase most likely. But what happened here? This is the risk as a share of risk-weighted assets. So something happened to the risk weights probably, and they are now. This is still this is to the second quarter. Now it's falling like a cliff.
Yeah.
On the third quarter, and this is like I talked with the banking expert how he sees it, and he said he doesn't really know how to explain this, but this is worrying. This is now below the late 2019 level. So for some reason, the risk weight on the balance sheet of bank is increasing rapidly, and this is third quarter. So what has happened till this point, we don't know. But the point is here that if you think of the banks are not tightening lending standards, and when the excess savings run out, households will start to default on their mortgages and loans. Banks will tighten further, corporations will go under, and they will tighten even further. So this will be a cycle. And if there is a crash or something in the asset markets, or something happened to the treasuries, God forbid, if there would be a default, the tier 1 capital would collapse, and it would mean an outright banking crisis in the US, and just in the commercial banks. We haven't touched the shadow banks, but I worry about those too. But the thing is, this figure tells that something is wrong in the commercial banking sector of the US while we head into a recession. This is not a good thing, not at all.
Okay.
Scared yet?
All right. So we have a weakening on all fronts.
Yeah. And it's happening
going into a recession.
Going into a recession, and this is
no cushion.
No cushion. Yeah, the thing is that there is very little cushions, and this is happening like below the surface. People do not see these things, but when you look at this, you start to get rather worried. So it's happening, but it's happening kind of under the surface. And this is, I think I saw this before. The U.S. corporate debt as a share of GDP, it's in all-time high still. So the things are not good in the US economy. And I really don't understand some of my colleagues who argue for no landing. It's absolute nonsense. At least if you look at the data, there is
what are you telling your clients to do besides get ready for difficult times? Is it still farmland and gold?
Yeah, we still go with that. And now we have the global liquidity database we're basically not telling them directly, but there is basically we're telling the same thing that I told you, that we would be short here.
Short, okay.
Yeah. And then right. I think if I would give
to take out the October lows, Thomas, you think?
Yeah, probably. So I would if I would be in the markets now, which I'm not, I would probably keep short now for a while and then look at things after a month in April. If there's full chaos, continue on the short and that. But it's our view that we are going to go down most of March, and it can escalate to a rout at the latter part of this month.
All right, and that's into the vernal equinox.
Yeah,
and the Fed in
and
late
the Fed
March.
and the liquidity, global liquidity, is just draining from the system.
Well, you filled up my cup of things that right in my face, and I mean we're looking at the markets and we're seeing that happen. What do you think happens to the dollar? Are they going to buy the dollar on this risk off move, or are they going to sell the dollar on this?
Yeah, probably. But another thing our analyst found already, we haven't he hasn't sent the data me yet, but he was telling me just this morning that China is dumping US treasuries, has been dumping
for a decade.
Yeah, but now it has accelerated.
Okay.
It seems. So I don't know. Usually the dollar is the safe haven, so it could be, it probably be this time around. But the one thing I want to mention about inflation, I'm doing an analysis. I publish it tomorrow in my newsletter, which you can find just Tuomas Malinen newsletter, and that's it. But there is something like hiding into the money, let's say the money supply of the United States. The first time I started to think that there's actual possibility that in a recession, if there's strong moves from the Federal Reserve, we could see a breakaway inflation. I don't give it a high probability, but the first time, I think all the history we know from the US and the monetary system, it's possible now, because of the actions taken by the Fed during the COVID spring. So it's rather interesting. I have to go through it one more time, so I don't want to talk about it too much. But the deflation scenario is not really likely at this moment. I would talk more about stagflation.
You could have deflation in asset prices and inflation everywhere else.
Yes,
is that what you're looking for? Okay,
that's possible. That's very likely, I would say.
Okay, so I'm going to go out and buy a ton of bananas today.
Yeah. That's always a good thing.
So get your food, and Thomas, best way for people to follow you and to get your reports and keep in touch with everything you're seeing every month.
You can find every link from my Twitter account. So just Google Tuomas Malinen Twitter. You can find everything there.
Okay, at MT Malinen is
my
Thomas's Twitter handle, and Thomas really does look at these things. He's been talking about this, and there's been some pretty negative action in the banking index last week, led by Goldman Sachs, which is best of breed, right?
Yeah.
So be careful. Do you think there's gonna be bail-ins, Thomas? Should I drain my checking account?
I think bail-ins are coming. That's almost a certainty in Europe, and could be even in the US. So be careful.
When by this summer?
I don't know. It's difficult to actual timing of crisis is extremely difficult, but I would say within a year.
All right.
But it can start much sooner. There was in Twitter, I think about a month ago, there was people posting videos of I think it was Bank of America. People were queuing, and they were complaining that there were money missing from their accounts.
Oh, I saw that.
Yeah, and I was thinking, is this the beginning? And the thing is that there is this one thing I could mention. There is this system put in place after the GFC, the global financial crisis, which I call the global financial lockdown. Jim Rickards speaks about that too.
Oh, yeah.
So that's actual, the laws and the regulations all are in place. So all they need to do is enact it, and suddenly your funds and your deposits are frozen. And it's actual possibility because the laws and all the gimmicks are there. So you have to be careful. You have to, cash is, or even though it's inflation is running really hot, you should keep cash and physical gold. That's my advice for the very adverse scenario.
I concur.
Yeah,
I concur. So, don't keep 50 grand in your checking account.
No.
Most people say keep it to a month or two of living expenses.
Yeah, that's a good advice.
Okay, so maybe you'll thank us for talking about this someday today.
Yeah,
that we're bringing it up.
Yeah.
All right. Well, Tuomas, again, great catching up with you. Really appreciate your work and you coming and sharing your wisdom and your insights with us on F.A.C.E. For years now. For years now. So I'll get in touch with you we'll be in touch probably in June.
Yeah,
everything should be in full bloom in June.
Yeah, they should. We'll see.
Well, take care of yourself. Go ahead.
Yeah, June would be good to check where we are. Yeah.
All right. So take care of yourself, your family, Tuomas, and
you too.
We'll talk down the road. And again, thank you for edifying F.A.C.E.
Thank you.
Yep. All right. Tuomas Malinen, everyone. Follow him at MT Malinen, MALINEN. And that's a wrap. You could join the team in 14 minutes on the Morning Edge. Good hunting to everyone, and don't just count your pips, count your blessings. Adios. See you, Laura.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.